After the Nasdaq recently formed out this symmetrical triangle, we have now seen that bearish crash here to the bottom out of this symmetrical structure. And so in today's video, we discuss whether this is actually the beginning of a deeper correction or may just be a smaller correction before we do see a continuation of this bull market. And so in today's video, let's first have a look at the technicals, then the fundamentals and macroeconomics. From the technicals, we do obviously have this broadening wedge here in blue, but we have also seen that symmetrical structure actually forming out here in yellow, which actually led the Nasdaq to this compression that we've now seen that bearish breakout to the bottom here, but we have seen that rapid bullish reclaim of those previous levels. And so whether this is actually the start of a deeper correction, the start of a kind of consolidation here, or just a small correction before we do see this continuation here, that is a question that we like to answer by taking a look at the most important fundamentals and macroeconomics. And so let's start right away with that. By the way, if you like this approach of taking a look at the past cycles and learn from them, please make sure to subscribe to our channel and like the video so you don't miss future update videos, and also support us here on our channel. Thanks for your support. Now let's have a look at the weekly chart of the Nasdaq. And what we'd like to take a look at in today's video is what happened previous to the 28 crash, to the great financial crisis. And what you do see here with the US 2-year bond yield and the US 10-year bond yield is quite interesting. You do see that previous to this big crash, we have seen obviously those yields definitely weakening. And so that is one of the signs that you tend to see before those big crashes happening. We're currently having this weakening as well. You do see that this is also one of the signs that you have seen here, also showing you the business cycle. You have seen that also happening, by the way, before the 2020 crash. And so whenever you do see those yields actually weaken by that amount, or in other ways, you can also take a look at the interest rates, since they are obviously also closely correlated to the yields. And you can say that when interest rates are falling, that has previously, historically, empirically, always coincided to a deeper structural concern in the financial markets. We have seen that 28 crash coincide to strong interest rate cuts. We have seen that COVID crash coincide to strong interest rate cuts. And guess what? We're currently also seeing interest rate cuts. And so that might just actually coincide to another deeper correction here, or maybe even recession at the stock market, at the Nasdaq. And so if you now have a look at the yield curve, you do in fact see that it is not inverted. We do see it in its normal position. But we have seen it being inverted just a few years ago. So that is definitely also concerning. We might just see this with a time lag basically happening. But we do see that those lower time frame yields do actually have low percentage yields than those higher bond time durations. And so what you are currently seeing is that we do see yields falling, obviously, but you do not see a inversion here at the yield curve. Obviously, you are seeing those yields currently falling because the demand for the bonds is actually increasing. We are seeing this actually reflecting the shift that we are seeing from the stock market to the bond market. We do see that the sentiment is shifting to a risk-off sentiment. Historically, that has always actually been a good move made by the investors to prevent actually holding stocks in those crises. We do see that this is quite simply a 100% hit rate indicator that those big weakenings here at the yields have always actually occurred previous to those big crashes. And so we are quite concerned because of that indicator that we are seeing here falling. But let's have a look at some others to actually validate this thesis that we might see a crash happening soon. by taking a look at the PMI, the Purchasing Managers Index, and that is just showing you the economic activity in the US. And whenever this indicator is actually below 50, it signals that you do have economic contraction, and above 50, economic expansion in the US. And this survey just shows you beautifully that previous to those recessions, we have seen the PMI actually weaken. You can see it here in 28, in previous to the great financial crisis. You have seen it here in 2020, and you are currently seeing it as well. We're in fact at exactly the same level at this survey, at this PMI rating that we've seen here previous to the COVID crash and previous to the financial crisis. And so that seems quite concerning as well. But to add on to that, we have to take a look at the DXY, the dollar index. The dollar's strength is obviously also closely correlated to the Nasdaq, what we do see at the stock markets, and we do see that those big crashes that we have seen actually coincided to this dollar index to strengthen. Whenever you do see those big crashes, you tend to see a strengthening dollar. You have also seen this here in COVID. And we might just see that kind of transition from a weakening to a strengthening dollar happening again here, as we've seen here with the great financial crisis. And this also is quite concerning to us. And we do believe that combining all of those indicators, we do have definitely a big of a percentage and possibility that we do see a crash happening next. It is definitely not unlikely. Maybe it's even likelier than 50%. Well, it's always hard to tell you a percentage of recession risk and so on, but we do in fact see those big indicators that we've just assessed actually signaling that we do see that we might see a recession happening here in the next few months. And so we are quite concerned. We do see those signals appearing right now. We do see also structural concerns here regarding the Nasdaq. We have seen a structural bearish breakout here. And so we are quite conservative concerning the US stock market right now. We do believe in the next few weeks and months we could see a deeper macro crash. And so I hope you learned something new. I hope you enjoyed the video, and I hope we could actually make you aware of that risk that we might just see this crash. If we achieve that, please make sure to subscribe to our channel and like the video so you don't miss future videos, and also support us here on our channel. Thanks for your support. See you the next time. Bye bye.